is up, everyone? Thank you so much again for coming to Investing City. We are here to help you become better stock market investors so you can make tomorrow better than today. If you haven't checked out our website already, please do so at www.investingcity.org. So today we're going to go over how to read a financial statement. So if you saw the last video, how to read a 10K, just like that, financial statements are pretty daunting. You see a ton of numbers, a ton of just things you might not really understand. So they're kind of scary, and today we're just going to break them down just like we did in the 10K. We did a little bit of the financial statements in the 10K video, so if you haven't watched that, please do so. But we're just going to break it down even further so that we can really dive in and become better investors. And so today we're going to look at a company called Arista Networks. And so we're just going to type in Arista Networks and specifically their investor relations page, actually. So a good place to start is the investor relations page because they have all the past earnings calls and everything you really need. So Arista is actually a software company that sells networking switches to data centers and things like that. We can do a deep dive on them later, but we're just going to go through and use them as an example to figure out how to read financial statements. So we're going to go right here to their press release of their first quarter in 2018. We're just going to click on that. And this actually gives their earnings, their latest quarterly earnings. As we see, they had revenue $472.5 million in the first quarter, and all these margins and stuff like that. But we're actually going to scroll down all the way to the bottom, and you'll see that they include some financial statements. And so there's three financial statements, as you might have picked up if you read the website already, but they are the income statement, the balance sheet, and the cash flow statement. So we have income statement, balance sheet, and statement of cash flows. So these are the three statements that you're going to look at as investors, and let's get right into it. So these are the quarterly numbers for 2018, and then it gives you a year-over-year comparison in 2017. So in 2018, we had revenue of roughly $472.5 million. That's 2018. And then 2017, we had revenue of $335.5 million. And so if you look at that, we can do the growth calculation, just simply this number minus 2017 divided by 2017, and in that we can see, if we get a percent here, 41% growth. So without any frame of reference, you can't really tell if that's good or bad. But if you've been looking at companies in the same industry as Arista, or even the same sector, more the technology, you can really tell that this is a great number, 41%. So investing is really about looking at a bunch of different things and kind of comparing and seeing the patterns. But we want to isolate these numbers so that we can compare them on a basis considering all the other factors as well. So if you just look at 41%, but they're losing a ton of money, that might not be as good as a company that's doing 41% growth but it's really profitable. And so just things like that, where you have to kind of compare companies on a holistic basis rather than on a certain number of factors. And so if we look down here, we have the total cost of revenue, which is their cost of goods sold, and then we can see their total gross profit. So if we do the total gross profit number, 0.9, and then we do the same thing in 2017, 214.2, we can see a gross margin number. So let's do gross margin here. And if you just do this divided by this, we have 64% gross margin. And we do that divided by the revenue, because that's gross profit divided by revenue, which is the gross margin. We can see gross margin increased a little bit, which is good because you want to see the trends of things. You want to see things going up most of the time. And then these are operating expenses, so we're going to stop after this, the income from operations, but that's essentially your operating margin. So then we'll do 138.7 and 73.4. So let's see the operating margin. Sorry, I'll put this down here. So this is just that divided by your revenue, because you want to see how much money you're making per dollar of revenue. So we have 21%, which, again, if you have no frame of reference, you don't know if that's good or bad. But here we have 29%. So as you see, it increased by almost 7%. Well, 7 percentage points. But if you just have no frame of reference, you don't know if that's good or bad. But if you've been looking at a lot of companies, if a company makes 29 cents on every dollar of revenue, and they're growing 41%, that's actually very impressive. So you can't look at things in isolation. We have to compare them to competitors. We have to compare them to other companies, similar characteristics. And so you can't look at them in a vacuum. But just from these numbers, they're looking really good. So let's move down to the other statements. So this is what's called a reconciliation. And so there's something called GAAP and non-GAAP. And so GAAP is basically just the government's standard for accounting. It's just the accounting standard. Non-GAAP is more of the company's way that they're presenting the earnings. And so these are called the non-GAAP to GAAP reconciliations. And we don't have to worry about that too much right now. But let's move now to the balance sheet. So this second item up here. And as we see, the current assets and the total liabilities. So the thing about the balance sheet is that it's important in some ways. So the main thing that we look for is just the amount of debt that a company has. So the company is just bounded by debt. The thing is that debt forces a company to pay interest expense. And if the interest expense is really high, then they're just paying all this money for borrowing debt. And so if a company doesn't have strong cash flows or negative earnings or something like that and a lot of debt, the company can eventually go bankrupt. And so that's something that we don't want to see. So we want to look at what's called long-term debt. And sometimes it's called different names, but here Arista does not have much debt at all. We can see it's probably under this other long-term liabilities. So $21 million of long-term liability, and that is about 5% of revenue. So even that's way less than the operating income. So we shouldn't worry too much about that because the interest expense will be even less. So that's the thing you really want to look at in balance sheet. We'll go debt levels, long-term debt, and then we'll just fill this out for the income statement as well. We want to see revenue growth, gross margin, operating margin. So these are some things that we're looking for. And then let's move down to the last statement, the statement of cash flows. And so here we see the statement of cash flows. And the thing you really want to focus on is free cash flow. So free cash flow is operating cash flow minus the PP&E, or the purchases of property and equipment, also called capital expenditures. So that's the thing we're really going to key in on. So we see in 2018, 195.5 million in operating cash flow. This is 2018. And then we see down here that the purchases of property and equipment were 6.3 million. So this is 6.3 in capital expenditures. So this is cash from ops and CapEx, capital expenditures, or purchases of property and equipment. So this free cash flow number is the cash from ops minus the CapEx. So this is our free cash flow. And the thing you want to look at this is in conjunction with the revenue as well. So this is the free cash flow margin. We do that divided by revenue. So 40%. So that means for every $1 of sales, 40% is turning into free cash flow, which is a really good number. A lot of these companies, maybe 5-10% is deemed pretty good, but 40% is really impressive. And so we can tell that Arista is a cash printing machine, which is really important for the valuation and things like that, but we can do that in later videos. But the thing is, you just have to look at all these things in context. If you're looking at just 41% without any frame of reference, or you're looking at 40% of free cash flow margin, it doesn't really make much sense. So that you have to look at these things at a lot of companies and just do this for other companies in the industry. But yeah, these are some main things to look for in these three statements. So we'll look at free cash flow. Just like we said in the 10K video, you can really look at every single metric and do financial analysis till you're silly. But the thing about investing is there's also an opportunity cost for your time, so you want to look at the things that give you the most bang for your buck, and these are the things that we believe do so. And so, thank you so much. I hope you stay with us for the next videos, and I hope you learned something today and became a better investor. So thank you again, investing.